This new chapter is beginning with some questions at a time when, of course, this seems cliche to say, but economic uncertainty remains high. I may have written that sentence more than anything else in the past few months. Among some experts, there's some concern. I recently spoke to Jay Ritter, an economist who is well known for his work in the research on the IPO market. And he noted some concerns regarding the extremely high valuation that SpaceX is currently being ascribed. Companies with that type of forward PE ratio don't necessarily tend to perform well in the recent years following their IPO, even if the trading debut goes extremely well. That type of speculation doesn't seem to be there for these. You probably heard the news story about the tech mogul who offered his mansion to trade for Anthropic equity. There's a big rush to get Anthropic equity right now. Some are getting very creative. Talk about unprecedented. Offering your house for company equity. When have we seen that before? In my experience, that's a new move based on this earnings season trend. And what experts have said, it definitely seems as though the software trade is not dead. That seems to be the definitive consensus. One thing I've been told repeatedly is that whenever something bad happens, flash in the pan, it's very easy to assume that a popular trade is dead in the water. I mean, markets are cyclical, they rebound, and these software companies have clearly made real progress, as evidenced by their numbers. Based on everything that I'm seeing, seems like the AI boom is alive and well, and that these two parts of the AI sector, your chips and your software, can coexist. I mean, innovative AI startups like Anthropic are never going to stop rolling these things out, but at least for now, software has proven that it can hold its own.
Right now, the market is undergoing a massive stress test. We're coming off of April where the S&P 500 shattered the 7,000 mark, fueled by a 28% earning growth rate that honestly most analysts didn't see coming. It doubled their expectations. But while the headlines are celebrating record highs, internal plumbing is showing signs of high pressure fatigue. We are currently watching a $725 billion AI arms race. That's nearly $750 billion being poured into hardware, and the market is starting to demand a return on the capital that many companies simply aren't ready to deliver. My guest today, who is consistently in the room with these high-stake decisions, are Samuel Brandt from Business Insider. Sam has spent the last few months grilling the heavyweights of the financial world's micro-strategists like Anthony Sacramone, George Noble, and Louis Navielli. He's gone and had conversations with the big short minds like Danny Moses and Andrew Left, and even sat down with Grant Cardone to talk about where the real capital is flowing. Sam and I were originally scheduled for an hour, but we had about 30 minutes for the session before he had to run and cover the breaking chaos over at the Federal Reserve. Because of that, this isn't a casual chat. It's a little more high-intensity executive briefing on the most consistent corners of the global market. In this episode, we're diving straight into the Fed, private credit's tug-of-war, specifically why Blue Owl Capital is surging 13%, while JPMorgan is simultaneously slashing their price target down to $10.50. We're breaking down the IPO drought and why the exit window for private equity looks more like a keyhole in this high-rate environment. Most importantly, we get into the weeds on the Warsh Fed. We talk about the mountain challenges Kevin Warsh and the unprecedented wave of dissents at the recent meeting that suggests the Fed's unified front is finally starting to crack. If you want to know which way the wind is blowing before it hits, this is the briefing you need. Let's jump into my 30-minute blitz with Samuel O'Brien. In February 2026, we witnessed the SaaSpocalypse, a 48-hour window where hundreds of billions of dollars in market value evaporated. Most investors saw this as a random disaster. But if you understand the logic of the ledger, you saw it coming. Today, we aren't just looking at the wreckage, we're upgrading your internal guidance. The last time Sam and I went live together was February 2026. Since then, Sam has been on tear, conducting massive interviews with the likes of David Leff, Anthony Sacramone, to name a few. While the headlines are obsessed with AI, software, the real war is being fought in private credit. Just today, Bank of America released a bullish report on Blue Owl Capital, positioning them as the primary architect of the AI data center build-out. But at the same time, JPMorgan has slashed their target to $10.50, signaling a massive disconnect in how the smart money views this debt. Is the next secular base or a data center debt trap? We're diving right into that. Hey, welcome back, Sam.
Thank you, Marcus. Great to be here.
Yeah. And for those who don't know, big shout out to all the people watching internationally, Japan, Korea, all around. We're doing this a little abbreviated. Sam is a journalist and he is busy. He's busy. Thanks for hopping on.
Never too busy for you, Marcus. So let's talk about private credit.
Let's go.
Now, that I think is a fascinating topic because right now it's earnings season and Blue Owl, the company that is at the sort of center, many would say, of the private credit fiasco that's been unfolding, well, they had kind of a surprise earnings report in the sense that it came out better than expected. Didn't seem like anyone was forecasting an earnings beat from them of all the companies. A lot of eyes were on the Mag 7, but that was something that really seemed to stand out. Regarding this sort of private credit saga, I mean, ever since Jamie Dimon first came out and made the now iconic cockroach analogy, that kind of, let's just say, kind of started the ball rolling on this market-defining trend. It's definitely been an interesting one to watch. And whether it's a debt trap, in your terms or not, is really up for debate. There doesn't seem to be a definitive answer, but based on what I've seen and what, not really me so much, but many of my teammates, because BI's finance team has been all over this, doing a great job covering the Blue Owl and the private credit sagas. What they seem to have found repeatedly is that it's complicated, but based on experts seem to be saying, investors are going to look to Wall Street when it comes to signals on private credit, because according to some experts, private credit wasn't something that was really discussed too much outside of Wall Street up until Dimon's now iconic speech that clued a lot of people into the fact that this could be a significant problem. One example that I can know is a few months ago, I spoke with George Noble, former Fidelity overseas fund manager, used to work for Peter Lynch, who has a lot to say about a lot of things. Private credit is one of them. And he made it very clear that he does think it's a bubble and that investors should be very worried. More recently, it seems like some others have said it's not as big of a deal as some of the alarmists may have said, but you noted that JPMorgan has slashed its forecast, I believe, regarding. I think it seems that if it's coming from a name like that, investors are going to proceed very cautiously. It's hard to be optimistic right now, even after Blue Owl did better than expected.
Interesting. Yeah. So you have, like you mentioned, you have Bank of America just came out today with this data or this report saying that Blue Owl's not as bad as they were. Blue Owl's report was better than expected. But I mean, people expected Blue Owl's report to be absolutely terrible, right? And then also you've seen the software sell-off and things going on inside there. Are the allocators you're interviewing finally is it finally clicking home base, or is there a bias to them to move capital into these high growth areas, private credit, high growth, high risk, I should say?
Well, that's a topic that people seem to be divided on. And I mean, it's complicated, especially with different Wall Street institutions having different perspectives. You noted B of A just came out and said that this is not that bad, but if JP Morgan is saying something different, it's hard to imagine that there's going to be much confidence in an area like this. As at the end of the day, the credit has still sort of been the poster child this year of just potential problems and kind of I don't want to say downward spiral, but it does seem like investor confidence has declined steadily. And a lot of people seem to be of the opinion that it's not about to rebound.
But then in the same breath, you have a lot of, like I said, investment of the private credit into software. And then you have companies, these hyperscalers who are increasing their CapEx and investment into these companies, which are also investing in private credit. Would you say that private credit is currently the canary in the coal mine to a broader liquidity event? I know you spoke with Danny Moses at The Big Short. So what are your thoughts there?
Well, that's the thing Danny and I actually did not discuss.
Okay.
Because it would have been a fascinating topic. Danny told me that he's constantly asked about what the next big short is, and he implied that he was kind of tired of that question, which I mean makes sense. So I actually did not touch that. Regarding your actual question, though, it really is difficult to say. I defer to the experts, the finance pros and the economists. And regarding pouring money in, I mean, well, actually, no. Regarding the canary in the coal mine analogy, that does seem to be the popular consensus. However, it will be interesting to see if, following the Blue Owl's earnings success, if that kind of shifts. Right now, it seems to be too soon to tell, so seems like something that the investing community will be watching for very closely.
Got you. And just to stay a little bit inside this private credit. So I know you interview guys, different sides of this private credit, right? Where people see some private credit is better than other private credit. What are you hearing from these individuals who actually run the private credit institution?
I can only speak to what I've been.
We're staying in the shadows of the private credit. We just saw Blue Owl surge 13% after its earnings beat. Yet JPMorgan is screaming sell with a target of 1050. Is this a liquidity trap, or is a $315 billion AUM in private credit the only thing keeping the AI data center build out alive? We're going to break down the tug of war that Wall Street doesn't want Main Street to understand. Stick with us.
Seeing and hearing, and based on the other reports, it does seem like the majority of private credit is seen in a negative light because maybe a broad spectrum, but many headlines are not positive.
Gotcha. Yeah, I think we spent a little bit of time sitting here talking about private credit. Let's shift over to the Fed. This week we had Kevin Warsh move over past the initial vote with Tom Tillis taking down his protest. We still have a lot going on with Chairman Powell, who's staying on. That's unprecedented. Well, it's not unprecedented. It's just been a long time since the governor stayed on after not being a chairman anymore. So what are you hearing on the Fed? I know your ears are down to the ground.
Absolutely. And doesn't seem like anyone was surprised by the decision to keep holding rates steady as sort of part of Powell's swan song. But based on what I've been told, there's definitely more surprising that there was some dissent this time around, which is an interesting sort of introduction to this job for Kevin Warsh as he's coming in. As my colleague Ali Kelly reported for BI, there hasn't been that many dissenting votes, and I believe it was more than 2 decades, which that's a long time
90s.
By these standards. So, yeah, wow, long before I was in the industry. So, considering that this new chapter is beginning with some questions at a time when, of course, this seems cliche to say, but economic uncertainty remains high. I may have written that sentence more than anything else in the past few months. And I know that's not breaking news to anyone, but right now, that seems to be the name of the game. According to the many people who reached out wanting to chat about it in the wake of the most recent Fed meeting, definitely seems to be the consensus. Things are shifting at a pivotal time, and now that we have this, not to say historic dissent, but in recent years, we haven't seen anything like this. So we're facing a complicated time, and there's definitely questions with no clear answer yet.
Gotcha. And people are wanting to talk about it. And as you mentioned, I think it was 8-4 as far as the vote the other day. There's been some commentary that's come out about some of the Fed governors as to why they voted that way. They said maybe they think that we may have to take rates higher. That was as recent as this morning. Just want to leave the openings where we could go up or down in rates. Kevin Warsh, I mean, I was live the other day and mentioned Kevin Warsh may be home alone in the Fed. Do you think he'll be able to handle this political pressure that will come from him? Do you think the data may not allow him to cut rates? Do you think he would raise rates just based on what you've heard from not Kevin Warsh himself, but from other sources?
Well, that's really tough to say. As I noted, right now we're in a place where no one really knows, but it does seem to be the consensus that yes, this political pressure is going to be complicated. Although, of course, Warsh, knew that going in. That said, there's a lot of speculation right now as to how he's going to handle it. Some have expressed that they find it a little funny that this is a position that is historically seen as not being an exciting one. I mean, being chairman of the central bank is seen as such a numbers by the buck, follow the rules position. But with the Trump-Powell showdown, for lack of a better term, that kind of thrust it just into the spotlight in ways that most people probably weren't expecting. And now that it's shifting again with a new Trump appointee, well, the consensus definitely seems to be that it's going to be very complicated, and the Fed is not supposed to be complicated. But right now, we are truly in, please pardon this phrase,
Man, if people were playing a drinking game every time you said unprecedented times, they'd be sloshed at 2 o'clock in the afternoon. Yeah. For those who are just joining, we had to hop on a little bit early. Sam has a lot going on. Samuel has a lot going on. He has to hop on and cover another story. But yeah, we're talking right now about the Fed. Also, another thing I want to let you know, anything we speak about, these are my views and Sam's views alone. These are our brain thoughts. So, going back into can't talk about the markets without talking about the Fed. As Sam runs over to cover the latest from the FOMC, we're dissecting the growing friction within the building. Kevin Warsh is facing a storm of challenges, and the recent meeting saw a staggering number of dissents, 8-4. That suggests that the unified front is crumbling. We're looking at what this internal rebellion means for your interest rates assumptions. Stay tuned. Conversation continues. Going back into the Fed, right? So what are you seeing with the direction? I know you mentioned that there seems to be some consternation. Do you think from like the big money bank and big investors, they have to think that there's going to be up or down as far as rates go when they make their CapEx projections? What are they saying?
It does seem like the pressure's going to lean in that direction based on what I've seen. Of course, this is all very recent and speculation's unfolding. Everyone wants to chime in. Everyone's got a take. But right now, it does seem to outweigh. But the focus seems to be on the fact that, end of the day, Warsh is a Trump appointee. And the president hasn't made any secret of the direction he wants rate cuts to go, or just rates to go in. He hasn't hid that. Definitely not. So that seems to be what experts expect the business world to be planning for.
Gotcha.
Even as we enter what could be, based on what some have said, a new era of dissent. It's not my phrase.
Gotcha.
It's
a quote. And that goes into, like you said, coming into the year, this year has definitely been different than we expected. People did expect the Fed to lower rates. So that was part of a lot of people's investment theories. One thing they didn't expect was for oil to be above $100 a barrel, which is where we're sitting right about now. And another thing they did expect was the IPO market to be popping. So what are you hearing on the IPO market right now, Sam?
Well, right now, it's a fascinating time because, of course, 3 of the most high-profile companies are getting set to go public. You've got SpaceX, you've got Anthropic, and you've got OpenAI. Essentially, the 3 companies that for so long were really in focus and were privately held. I remember getting questions from people who would ask me, how can I get exposure to? And it was always those 3 companies. Well, now we're moving into an era where they're all going to be publicly traded. And it's easy to see why so many people are so focused on what's become known as the big 3. One thing that I have heard is that with the SpaceX valuation, among some experts, there's definitely some concern. I recently spoke to Jay Ritter, an economist who is well known for his work in the research on the IPO market. And he noted some concerns regarding the extremely high valuation that SpaceX is currently being ascribed, and based on history, how companies with that type of forward PE ratio don't necessarily tend to perform well in the recent years following their IPO, even if the trading debut goes extremely well. That type of speculation doesn't seem to be there for these, well, not for Anthropic. I mean, you probably heard the news story about the tech mogul who offered his mansion to trade for Anthropic equity. As one of my colleagues reported, there's a big rush to get Anthropic equity right now. And as my colleague Ben Bergman wrote, quote, some are getting very creative. I mean, talk about unprecedented. Offering your house for company equity. When have we seen that before? In my experience, that's a new move. I say, it seemed there was a similar focus on OpenAI until fairly recently, when a couple days ago, the company's CFO noted the potential problem paying their column with some of the costs they're facing. And of course, that sent a lot of tech stocks down, and it led to speculation. So right now it's complicated, and it doesn't seem to be helping that Sam Altman and Elon Musk are currently in this historic trial. Two of the most high-profile people in the tech world facing off against each other, and everybody wants a front row seat.
Right. Just sit on the trial for a second. With that trial, what are you hearing? Are you hearing anything with the trial? As far as, I mean, and we're not getting political here. Let me put it out here first. That if you just hear Elon Musk, like the basic case he's trying to make, that I invested at a nonprofit and you turn it to a for-profit, I think Sam Altman was saying that ain't quite how it went. What are you hearing, Samuel?
Well, based on my company has been reporting, it's essentially that. It's Musk trying to paint one picture and Altman saying, hey, wait a second. And doesn't seem like anyone's surprised by all the back and forth, because, got two people with a lot at stake. And since Musk has made attempts to take over OpenAI or just gain control, and this is a saga that seems to have been, well, I know it has been years in the making, leading up to, I don't want to use the word showdown, but that is the one that comes to mind. And that very much seems to, that there's no doubt that it's complicated, and that it's going to be a lot for the lawyers to dig through. But the world's watching as what promises to be an exciting saga kicks off.
Got that right. Yeah. And as we were talking earlier this week, we were speaking a little bit about this offline. I said, hopefully we would have a break in this, but I don't think we're going to have any decision in this. Not today. It's going to be one judge who decides it. I don't think there's a jury up there. So I think it's just one judge that decides it.
Talk about pressure. One person presiding over a court case that everyone is clued in for, or tuned in for, I should say.
Right. And I think if I remember correctly, the judge is a Biden appointee, maybe. But, people always want to make stuff political. That's not what we do here. That's not what we're here for.
Exactly.
What are some other interesting IPOs you're hearing about that people may want to hit the ground?
Well, actually, Bill Ackman's Pershing Square recently IPO'd, and high-profile company, very high-profile person, especially in the financial sector at the helm. And as my colleague Naomi Buchanan reported, it ultimately did not go well. And of course, most high-profile companies will at least have a really good first trading day because everyone's excited and everyone wants to get in on it. And so seemed like a surprise that this fairly high-profile IPO did not go as well as some might have expected. Although the fact that Ackman chose to go public very close to several of the most high-profile companies in the world going public. It's definitely a decision that seems complicated. Trying to remember the exact phrasing, I remember he posted to X that he did not blame retail traders for what happened. Seems there might have been speculation that was the reason. Definitely complicated moment, but it does seem like the focus is going to shift back very quickly to these other companies that a lot of people seem to want exposure to very badly.
Right. And as we go into the Pershing Square, Bill Ackman's everywhere. Just speaking, I run an RIA, and when we're doing like custodial stuff, there's a lot that goes back to Pershings when you're moving accounts over to your custodian. Shout out to Altruist, my custodian. But in this, you mentioned the IPO. David Snyder, who was on an episode, it has yet to be released. He was actually talking about, David Snyder actually predicted the 2008 bottom, but he actually was speaking about, he released a report today, or some of his data on LinkedIn, and it showed where some companies, he said it 5 years ago, they're overvaluated at the IPO. So speaking just like you're saying, and 5 years later, they're lower. I think he said ServiceNow. I can't remember which one was the headline company, but it was one that reported today. With that being said, and we're talking about software, we started with the SaaSpocalypse last time when we were together in February.
Yes.
Software versus semis. We just spent some time. Where are you seeing there right now?
Well, coming off of earnings season, it's pretty hard to miss the fact that several prominent names in software, I believe Alderson was one, I believe Trillo was another, reported strong earnings. And this comes just a few months after, of course, the quote, SaaSpocalypse. I remember you and I discussing it, because at the time, it was very fresh that some disruptions from Anthropic had unexpectedly sent software into a tailspin. I mean, based on this earnings season trend and what experts have said, it definitely seems as though the software trade is not dead. That seems to be the definitive consensus. One thing I've been told repeatedly is that whenever something bad happens, flash in the pan, it's very easy to assume that a popular trade is dead in the water. I mean, markets are cyclical, they rebound, and these software companies have clearly made real progress, as evidenced by their numbers. So Wall Street's made it pretty clear that it's not abandoning the software trade. Of course, chip stocks, at least the leading ones, have proven that they're not going anywhere. The AI trade's definitely seen some negative speculation over the past few months, as tends to be the case. But chip makers, for the most part, seem to have done for all just fine. And I know there's talk of, say, rising competition within the Mag 7, but based on everything that I'm seeing, seems like the AI boom is alive and well, and that these two parts of the AI sector, your chips and your software, can coexist. I mean, innovative AI startups like Anthropic are never going to stop rolling these things out, but at least for now, software has proven that it can hold its own.
Exactly. And I mean, the Philly semi index is up a crazy amount, but the IGV's been up too as well. You know, you have inside of software, you have some companies like, so you mentioned the Mag 7, you have Google, who just reported a couple of days ago, Alphabet. Inside of their company, they have the total stack covered, right? They've started making TPUs, they have cloud. We're not even talking about Waymo, YouTube, companies like that, you know, inside the same company. But then you have another company in the Mag 7 who doesn't have these things, Meta, right? And once again, we're not making stock recommendations or anything. We're just talking about numbers. But you have Meta, who's the complete opposite. They don't have any chips. They don't even have a cloud. What they do have is advertising, right? Meta drives people on advertising. Like, they may have one of the best advertising businesses in the world. So one would wonder, why are they spreading out? Those are the kind of questions people may be asking when it comes to semis versus software versus CapEx. Do you see the model moving towards where Google is right now, where they just bring everything in-house?
Kind of seems like the focus is still on in-house. I mean, just on this past, I'm just going to say earnings week, because you saw 4 of the biggest names in tech report all on the same day. That's a lot to cover. Generally speaking, I mean, it is true that Alphabet stock was the only one that rose out of the 4 that reported on Wednesday. There's definitely a little negative speculation, I think. But, I mean, while it's true that some have said that Alphabet may be the new AI sector bellwether to look to, also it's important to note, as experts have said repeatedly, we haven't heard from Nvidia yet, because Nvidia likes to report after everyone else. And so until that happens, the consensus seems to be that it's going to be hard to really definitively assess the whole state of the Mag 7, specifically the chip part of it, post earnings, because the company that spurred the chip revolution, that being Nvidia, has not revealed anything yet.
Gotcha. Yeah. And Nvidia, I feel like, is, when it comes to Mag 7 and earnings reports, I feel like Nvidia is like CPI, PPI, and then you can kind of glean what PCE is going to be. You've heard all these companies talk about their investments into chips, and that all kind of flows back to Nvidia and Taiwan Semi. Intel, which is taking market share and having a crazy run right now. It's just absolutely ridiculous what we're seeing with these companies here recently. What surprised you the most with these earning reports from tech?
Off the top of my head,
Off the top of your head.
I would say that the thing that most people weren't expecting was probably the Blue Owl earnings success. It doesn't seem like anyone was too worried about anyone in the Mag 7. These companies are consistently strong, and even if some numbers come in a little below expectation, these are the stocks that can bounce back, as history has proven repeatedly. But for the company that essentially, that seems to be the one that people associate with a trend that has now linked to analogies like the cockroach.
Thanks, y'all. Sam has to run. He's got to go cover some stuff right now. Check out his next article. Thanks, Sam. We appreciate you. Peace. And that was a 30-minute macro blitz with Samuel Brent from Business Insider. As you can hear, the market right now isn't just a monolith. It's a series of high-stakes tug-of-wars. Whether it's the 13% surge in Blue Owl Capital to find the skeptics at JPMorgan, or the massive valuation gap where Meta is showing the receipts at 22-ish forward earnings, while Microsoft carries the bill for 6 figures in billions, so 12 figures in hardware spending. These aren't just numbers on a screen. They are indicators of where the smart money is rotating as we move deeper into 2026. One of the biggest takeaways from me today was our discussion on the Fed. Watching Kevin Warsh navigate an unprecedented wave of dissents not seen since the 90s tells us that the days of a unified, predictable Federal Reserve are behind us. For you as an investor, that means that the margin of error has narrowed. You can't rely on a Fed put or a general market lift anymore. You have to look at the individual ledgers, identify who is actually generating AI ROI, and understand the plumbing of private credit before you put your capital at risk. If you found value in this high-speed briefing, make sure to subscribe to the podcast and find us on YouTube, Marcus Sturtevant Sr., for the visual breakdowns of any charts we may have. Also, a huge shout out to the nearly 1,300 of you who've joined our Wall Street South Journal newsletter on LinkedIn. Your support is the reason we can bring in guests like Sam just to give us the Main Street perspective on the global shifts. I'm Marcus Sturtevant Sr. Keep your eye on the data. Keep your emotions on the table. Keep your emotions out of the trade. Main Street Heart meets Wall Street Smarts. I'll see you next time. Thanks for joining us for this bonus episode with Samuel Brent.